Hey everybody, Garrett Baldwin. It is 11 o'clock on August 22nd. I wanted to give you a little bit of a rapid reaction to what just happened because the S&P 500 is absolutely ripping higher and a lot of people are just questioning, well, what did Pal just do? What did I just hear? I was just talking to a friend of mine up in New York, and he said, well, I think the mission was accomplished. Say absolutely nothing and just keep the markets happy. That's not even close to what happened. And we're going to break this down a little bit in this video, just trying to give you a little bit of an understanding of what this speech was about. Remember, Jackson Hole is the annual symposium that is hosted by the Federal Reserve. And occasionally we have major developments that transpire that shift the tone in policy and ultimately impact markets. In 1993, the Federal Reserve began the concept of inflation targeting, which is effectively to create inflation in order to spur wage growth and prevent deflation in the economy on the back of major events happening in the mid 1990s, like the fall of the Berlin Wall, the rise of China and its less expensive labor class, and deflation from e-commerce. In 2010, we saw a lot of focus on what was happening with quantitative easing. 2012, focusing on the confirmation on inflation targeting. And then in 2020, the Federal Reserve announced this new inflation based focus on how they were going to average out expectations for inflation. This was a major framework that set the tone for the next 4 years. And as we know, inflation has never been transitory. In 2022, which was very, very important as well, the expectation was that Powell was going to accommodate to the markets. He didn't. He said there would be pain. And about 6 weeks later, we had the gilt crisis that transpired in Europe. Well, today we had something different. And what was different was pretty monumental. Again, the expectations coming in was a Machiavellian conversation about whether or not Powell was going to want to be feared or want to be loved. The concept of the independence of the Fed in trying to ensure that it maintained its stability and commitment to data, or if it was going to appease the markets and effectively fall in line with what the White House has been pushing for in terms of rate cuts. What we got was this kind of gargled expectation and focus. What we got was this capitulation to the idea that they are going to be able to contain inflation in the future. And they made a very Faustian bargain today by choosing inflation in the future to allow that to rise higher because of uncertainty in the labor markets. So, to give you a little bit of a quick breakdown on this, there really are two paths. You can either take the 1970s path of inflation, which is exactly what we've been arguing is going to transpire, and exactly why we have been positioning ourselves in capital efficient assets, capital efficient companies, gold, crypto, and anything that isn't nailed down, because all roads point to more monetary inflation in the future. Now, as we talk about this, the thing where we started off with, Powell says something that's completely out of the way, and he says, in this environment, distinguishing cyclical developments from trend or structural developments is difficult. That's basically saying we can't tell if changes are temporary or if they're permanent when it comes to understanding the data. Their models are broken, and the labor market absolutely proved this when he was talking about the fact that average pace of only 35,000 per month over the past 3 months, down from the 168,000 per month in 2024. Unemployment's at 4.2%. But if we went to the labor force participation rate from not too long ago, we would be approaching about 5%. Powell tried to explain labor market has softened in line with demand due to the sharp fall off with immigration. So supply is falling, demand is falling, and we have this complete instability and focus. It looks balanced, but it's a very fragile labor market. He also said that tariffs were a concern on consumer prices. Core goods went from deflation to 1.1% annual inflation, and he said the notable shift from the modest decline seen over the course of 2024. Well, his hope is that this is a reasonable base case that the effects will be short-lived, one-time shift in price level. And then he immediately hedged because that's what this guy does. He said it's also impossible, however, for the upward pressure on prices from tariffs could spur a more lasting inflation dynamic. They are choosing higher inflation over labor insecurity, and they are hoping that it's transitory. They're hoping that stagflationary pressures are not permanent. Does that sound familiar to you? In addition, they said that they killed their 2020 framework. And this is significant. He said, we returned to a framework of flexible inflation targeting, and he limited the makeup strategy. Why? Because Powell just admitted that their promise of moderate inflation overshot constantly. There was nothing intentional or moderate about the inflation that arrives, he said. Of course not. That's been the argument the entire time. We've been sitting here saying the money printer is going to continue to run. We are incapable of preventing inflation. They have been tightening with one hand and running money through the shadow banking system with the other for the last 3 years. And yet they sit there and they wonder, why is inflation still elevated? What are the challenges here? Finally, it's the balancing act. The key admission is about inflation. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation, a situation that they have created. So, Powell then finally described the labor market as a curious kind of balance that results from a marked slowly in both the supply and demand for workers. That's basically just means we don't understand this. So what is the end goal of this? What is the key thing that we need to focus on? It goes back to exactly what I have been talking about for the last year. The things that are going to continue to shape the next 36 months: de-dollarization, monetary expansion, ongoing expansion of global liquidity, the ongoing focus, again, on short-term T-bills. And as we are seeing, everything is rising right now. Expectations for a weaker dollar, focusing on a cheaper debt, trying to accomplish faster growth. And our core grouping of things to own remain the same. The monetary anchors of gold and silver. We focus again on capital efficient stocks, the companies that actually can turn a dollar into many. Visa, Domino's, Deere, things along those lines. Even Berkshire Hathaway, look at Stu. Utilities and midstream energy. The power cycle has started. We're going to need significantly more electricity in the future. Look to the utilities as they continue to run. Look to diversify outside of the U.S. dollar. Look to Switzerland, Poland, Singapore. We talked about this morning, the idea that other nations are going to continue to benefit from the weaker dollar, or they're going to take their currencies back home. Over and over again, all the roads shift toward monetary expansion, and now we have the possibility of stagflation. You are seeing every momentum stock that is not nailed down rallying right now. Why? Because more capital flowing in, expectations of lower rates, improving the overall collateral multiplier, and stuff that might not even be worth anything, just absolutely running. H. Hut Corp, pure momentum, running to the upside. Everything that isn't nailed down today, gonna run to the upside. Everything that's not that's being shorted right now, gonna run to the upside. It's going to be a wild next couple of weeks. We are in green territory across the board. I continue to advise you to take some gains if we continue to run into the next week. Look for the next move on the S&P 500 to most likely be toward the overbought period, and at that point, we will reassess. But for right now, I'm glad that we didn't get into a red position and try to move to cash. This really was a very difficult environment to try to navigate. But once again, they have chosen to allow inflation to run at the expense of having a labor market meltdown. They have chosen the 1970s path to the 1930s. And this is exactly what we have been talking about and writing about for about 2 years, going back to the Hedge of Tomorrow article that we wrote back in March of 2023, in which we had written this report talking about the differences between gold and Bitcoin. And on top of that, the general report that we had, the Hedge of Tomorrow, which is available again at that site. But if all you have to do is just take a quick look at what we were pointing to, just overall expansion in debt going to continue to rise. They are going to try to inflate away that debt as best as they possibly can. We are going to see higher S&P 500, high Qs, higher monetary policy cycle. And again, it's all about understanding what to own. Fortress stocks, those high capital efficient stocks, smart risk stocks, stocks with high F scores and low gram scores, breaking above their 20-day moving averages, owning some gold, focusing on putting your money in the money markets when you need to deploy it fast, not keeping it in a bank account, keeping it in a place where you're going to get some yield, and continuing to focus on the overall focus on momentum. Momentum remains strong. It's going to be a wild week for a lot of short squeeze stocks. Do yourself a favor. Don't try to chase too many things. Look for any bargains that there are on things that are real. Look for companies that have low intrinsic value and high quality. We'll do a full screen on that this weekend. I'll send it to you this weekend. But for right now, just take advantage of what the market has given you. It is a very kind of stunning overall development. But again, it's part of the joy of following the markets each day. And I hope that you get a lot out of this analysis, because I do truly treat this event annually as if it is my Super Bowl. All right, that is my recap for right now. I will catch up with everybody in a little bit. Look for additional analysis over the weekend, and we will go from there. And I will be back on TheoTrade if you are a member today at 3 o'clock to talk about this for the final hour of the day. Take care, everybody.